If you are between 60 and 63 years old right now, Congress gave you something in 2022 that almost nobody told you about. A 4-year window to contribute more to your 401k than any other age group in America. More than a 30-year-old, more than a 50-year-old, more than anyone. And the window is open right now. It is called the Secure 2.0 Super Catch-Up Contribution. Starting in 2025, people aged 60, 61, 62, or 63 can contribute up to $34,750 per year to their 401k or 403b. That is $11,250 more than the standard age 50 catch-up of $31,000. And it is available for 4 years only, from age 60 to 63. At 64, it drops back to the standard amount. This video is specifically for people who are 60, 61, 62, or 63 right now. If you are in this window, this is the most important retirement savings opportunity available to you in 2025 and 2026. If you are younger, share this with someone who is in this window, because most people in these ages have no idea this exists. By the end of this video, you will know exactly how much you can contribute, whether your plan has adopted this provision, how to increase your contribution immediately, and how to calculate the real dollar impact on your retirement over the next 5 years. Let us start with the math. The contribution limits for 2025 and 2026. For everyone under 50, the standard 401k limit is $23,500. For everyone 50 and older, you can add a catch-up of $7,500, bringing the total to $31,000. For people specifically aged 60, 61, 62, or 63, the super catch-up allows an additional $11,250 beyond the standard, for a total of $34,750. These limits apply to your contributions only, not your employer match. Your employer match is separate and on top of these limits. So if your employer matches 4% of your $72,000 salary, that is $2,880 in employer contributions on top of whatever you personally contribute. The 4-year window impact with real numbers. If you maximize $34,750 per year for all 4 years from age 60 to 63, with a conservative 6% annual return, you accumulate approximately $157,000 by age 64. Compare that to the standard $31,000 limit over 4 years, approximately $136,000. The super catch-up adds roughly $21,000 in just 4 years. Now, the compounding that really matters. That $21,000 extra accumulated by age 64 continues to grow for the next 20 to 25 years of retirement. At 6% per year, $21,000 becomes $67,000 by age 84. The 4-year super catch-up window does not just help you at 64, it helps you at 74 and 84 as well. What if you cannot maximize the full $34,750? That is fine. Every extra dollar you contribute above $31,000 helps. Even contributing $2,000 more per year than the standard limit, $33,000 instead of $31,000, adds approximately $8,700 over 4 years with growth. Use as much of the window as your budget allows. Now, the most important question. Has your employer plan actually adopted this provision? Secure 2.0 made the super catch-up available, but individual 401k plans must actively adopt it. Not all plans have done so yet. You must confirm with your own HR department or plan administrator. How to find out in 5 minutes. Call your HR department or log into your 401k plan portal. Ask one specific question. Has our plan adopted the Secure 2.0 Super Catch-Up Contribution Limit for employees aged 60 to 63? Some HR representatives may not know. Ask them to check with the plan administrator directly. If your plan has not yet adopted it, you can advocate for adoption. Ask HR to request plan adoption from your plan sponsor. Many employers simply have not gotten around to implementing it yet. Your request may accelerate the timeline. And if you have significant influence with your employer, presenting the business case for employee retention can help. What if your employer does not offer a 401k at all? If you are self-employed or your employer does not offer a plan, a solo 401k also allows the super catch-up if you establish one. Contribution limits for solo 401k in 2025. $34,750 in employee contributions for ages 60 to 63, plus up to 25% of net self-employment income as employer contributions. Now the important nuance that affects higher earners. Starting in 2026, if you earn more than $145,000 from your current employer in the prior year, your catch-up contributions, including the super catch-up, must be made to a Roth 401k rather than a traditional pre-tax 401k. What this means in practice for high earners: if you earn $160,000 and are aged 61, your standard contributions can still go to a traditional pre-tax 401k, but your catch-up amount, the portion above $23,500, must go to Roth. You lose the immediate tax deduction on the catch-up amount, but the Roth grows tax-free and withdraws tax-free. Is the Roth catch-up actually a bad thing for high earners? Not necessarily. If you expect to be in a similar or higher tax bracket in retirement, paying tax now on catch-up contributions at your current rate and letting them grow tax-free may be the better long-term outcome. The Roth restriction might be an accidental benefit for some people. If your plan does not yet have a Roth 401k option and you are above the $145,000 threshold, you face a temporary limitation. Work with your HR department to add a Roth 401k option. Until then, the catch-up contributions are technically not available to you under the new rules. This is a plan design issue, not a personal one. Let us talk about the mechanics of actually increasing your contribution. This sounds simple, but many people get confused about how to do it. Here is the step-by-step process. Step 1. Log into your 401k plan portal. Every major provider, Fidelity, Vanguard, Schwab, Empower, Transamerica, has an online portal where you can adjust contribution amounts yourself without going through HR. Find the contribution rate or dollar amount setting. Step 2. Determine your target contribution amount. Divide your desired annual contribution by your remaining pay periods this year. If you want to contribute $34,750 and you have 20 pay periods left, you need $1,737.50 per pay period. Adjust for what you have already contributed this year. Step 3. Enter the new contribution amount as either a percentage of salary or a flat dollar amount per pay period, depending on what your plan allows. Submit the change. Most plans process changes within 1 to 2 pay periods. Confirm the change was applied correctly when your next paycheck arrives. Step 4. If you cannot afford to maximize immediately, consider increasing contributions by $200 to $300 per month and doing the same again in 3 months. Gradual increases are more sustainable than sudden large cuts to take-home pay. Even a $500 per month increase, $6,000 per year, meaningfully closes the gap toward the maximum. Let me show you what this looks like for a real person. Sarah is 62 years old. She earns $68,000 per year as a school administrator. She has $145,000 in her 401k. She has been contributing $23,500 per year, the standard limit. She just learned about the super catch-up in our last video. Sarah confirms with her HR department that her school district plan has adopted the Secure 2.0 super catch-up. It has. She has 2 remaining years in the 60 to 63 window, ages 62 and 63. She decides to increase her contribution to $31,000 per year. Not the full maximum, but $7,500 more than she was contributing. Sarah calculation. Over 2 years, she contributes an extra $15,000 above what she would have without the catch-up increase. With her existing $145,000 and standard growth of 6%, her account reaches approximately $195,000 by age 64. With the extra $15,000 in catch-up contributions, it reaches approximately $211,000, a $16,000 improvement from a relatively modest change. Over 20 years of retirement, that extra $16,000 at age 64, growing at 6%, becomes approximately $51,000 by age 84. Sarah traded a modest lifestyle adjustment for 2 years in exchange for $51,000 of additional retirement wealth over 20 years. That is the compounding power of using the window. Second case study. Michael, 61, earns $185,000 as a regional sales director. He is above the $145,000 Roth catch-up threshold He has been contributing the standard $31,000 per year. His plan has Roth 401k as an option. Under the 2026 Roth catch-up rule, Michael must direct any catch-up amount, the portion above $23,500, to his Roth 401k. His $31,000 standard catch-up already follows this rule. He wants to use the full super catch-up of $34,750, so his structure is $23,500 to traditional 401k, plus $11,250 to Roth 401k. Michael has 3 remaining years in the window. Over 3 years, he accumulates an extra $33,750 in Roth 401k contributions above the standard limit. With growth, this becomes approximately $40,000 in Roth by age 64. This $40,000 and all its future growth is permanently tax-free, including in retirement, when his income will likely still be significant. What if your plan has not adopted the super catch-up yet? You have options. First, confirm whether your plan intends to adopt it and when. Many plan sponsors have a timeline for implementation that simply has not happened yet. Second, if you are self-employed or have a side business, a solo 401k gives you access immediately without waiting for an employer plan. Third option, maximize contributions to a traditional or Roth IRA while waiting for your plan to adopt. IRA limits in 2025 are $7,000 for everyone, plus $1,000 catch-up for ages 50 and older, so $8,000 total. It is much less than the 401k super catch-up, but it is better than the alternative of not saving more at all. Fourth option, if your employer offers a 403b or 457b plan in addition to or instead of a 401k, those plans also have the super catch-up provision under Secure 2.0. Teachers, government employees, and healthcare workers often have these plans. The same $34,750 limit applies. Your Super Catch-Up Action Checklist. 4 specific actions to complete this week. Action 1. Confirm your age. Are you currently 60, 61, 62, or 63? If yes, you are in the window. If you turn 60 this year, the window starts now. If you turn 64 this year, this is your last year to use the super catch-up amount. Your birthday determines your eligibility for the full year. Action 2. Contact HR or your plan administrator today and ask specifically, has our plan adopted the Secure 2.0 super catch-up contribution provision for ages 60 to 63? If the answer is yes, ask for the maximum contribution amount and how to update your contribution election. Action 3. Calculate how much more you can contribute per paycheck without creating financial hardship. You do not need to maximize immediately. Even $100 to $200 more per paycheck is meaningful. Calculate your annual target, divide by remaining pay periods, and enter the new amount in your plan portal. Action 4. If your plan has not yet adopted the provision, put a calendar reminder for 90 days from now to check again. And in the meantime, maximize contributions to a Roth IRA, $8,000 per year for ages 50 and older, as a bridge strategy. If you are in the 60 to 63 window and this video helped clarify the super catch-up opportunity, please share it with one person who is also in this age range. Most people who could benefit from this have never heard of it. Sharing is the most valuable thing you can do with this information. Drop a comment below. Have you confirmed whether your plan has adopted the super catch-up? And are you in the 60 to 63 window right now? Your answer helps me understand who is watching and what follow-up questions to address. Subscribe to Calm Money Retirement. Every Tuesday and Friday, one retirement topic explained slowly, clearly, and without pressure. This Friday, 5 things to do with your money in the year before you retire. If you are within 12 months of your target retirement date, that video is essential viewing. Disclaimer. This video is for educational purposes only and does not constitute personalized financial or tax advice. Secure 2.0 contribution limits, income thresholds, and plan adoption requirements vary and change annually. Not all employer plans have adopted all Secure 2.0 provisions. Always confirm contribution limits and plan rules with your plan administrator and consult a licensed CPA or fee-only financial advisor for your specific situation. Calm Money Retirement is not a registered investment advisor.